Devina Mehra right here to explain us what is happening in the world and how is it that you as investors should be looking at the ongoings. Devina, welcome to our ET Now studios. The first time, right?
I think so, at least for many, many years.
Many years. So what brings you here?
So among other things, my book.
Yes, congratulations, and what a success it's turned out to be.
Yes, thank you. I mean, that was totally unexpected that it would go right up to #1 on Amazon, all books category.
Yeah. And yeah, #1 on everyone's mind is, what is Trump up to? How do you make sense of what's going to happen and how the world is going to be maybe even 3 months from now?
Very difficult to say. I mean, when long before he took office, when he had just won the election in November, I had written a piece for Economic Times saying that whoever is predicting that this will happen to the stock market and that will happen to the bond market, what are they smoking? Because you do not know what this guy is going to do, and you are talking with confidence on second order and third order effects. And to compound Trump, you had Musk. So if you have to compound uncertainty, that's a dream team, and now you're seeing them in action. So very difficult to say. I mean, we are in uncharted territory, and the whole point is that I do not know what problem is he trying to solve with the tariffs, because the US economy was almost at full employment anyway. The unemployment rate has been very low. So it's not as if that people are not getting work because the manufacturing is getting done elsewhere. So what is the problem that you will solve by putting the tariffs? And debt is a very vague thing, because if you really put brakes on the economy, which is what he's now doing between inflation. Already, I mean, even a month ago, inflation expectations in the US had gone up to 3.5%, and now for the medium term, and now I'm sure it might be higher whenever is the next number comes out. So you are doing something which is just shaking up the economy with no real payoff. I mean, the only reason right now the labor numbers are not looking that great is because of Musk's dodge, where you are firing people right, left, and
which
center.
he may quit soon when the job is done.
Yeah, and the tariffs themselves are not rational. I mean, they are just predicated on the trade deficit with the country, not the tariff barrier of the country. I was reading somewhere that Vietnam had some 5% average tariff, and they've been hit with some 47%. So, I mean, even if they bring that 5% to zero, how is that going to change the 47%? Because it is that you can't expect look at India. India's per capita is 3% of the US. Even on a purchasing power parity, we are 10%. So, we are never going to be able to buy that many US goods. I mean, only thing we can buy now is oil. Because US is the largest producer of oil. So I think if you want to balance the books with US, that's the probably the lowest hanging fruit. So, I mean, US, as far as the markets are concerned, again, it had a very long period of outperformance, I think about 12 years or so. And for a time, I had been watching that sometime that would end. But I think Trump has just hastened the end of the US outperformance, maybe on the economic side also. I was looking at Fareed Zakaria's podcast, and he was talking about that in 1990, the European Union and US as a size of the economies were almost the same. Now US is 80% larger. Japan used to have a per capita higher than US. Now it is much lower. Even the poorest state in the US has a per capita more than that of UK and France and all that. So as I said, there was no problem to solve. You are breaking something that wasn't broken.
Yeah, fixing it in his terminology. But Devina, I mean, I understand that, and there are many, sort of analogies there that this is like the 1920s Great Depression. We don't know whether recession is going to stall here. Is it going to lead to depression in the world? Very recent examples were 2008, 2020 when COVID hit. How different is it this time in terms of what the equity markets are doing?
Yeah, but then look at what happened in 2020. That was today I posted that people are saying the news is not going to get better. So how is how the market's going to behave? I said if the beginning of 2020 I would have told you that there would be a pandemic that hasn't happened in a century, which will kill 7 million plus people in the world, which will mean that hotels, aviation, retail, autos will go to zero revenue for a year, and many other industries will also take a big hit on their revenues. How many people would have predicted a equity bull market?
Yeah.
So equity markets are not that predictable. As far as India is concerned, I do not think you are in high risk territory. As far as the large, steady portfolio is concerned, small micro caps, it's another story. You know, that's, and my stance on this has not changed in the, I think, almost 3 quarters now. So I've been saying exactly the same thing, that get into a steadier portfolio and get out of the frothy areas of the market. And I don't think there is a huge risk, because you had a whole decade of below normal returns in that 2010 to 20 decade, which was that you put in 100 rupees in 10 years, you get 230 rupees when fixed deposits would have given you 200. So that's what created this room for the post-COVID bull run. And still you are not way above the trend line or anything like that on any parameter. So that's the plus for India. So if you were waiting on the sidelines last few months saying correction hoga, then I'll invest. So it's time to be invested to the extent of your equity allocation, which should never be 100%. Again, you know, my stance on this again remains unchanged, that no matter how young you are, etc., equity should never be 100% of your portfolio. But whatever is your equity allocation, now is the time to remain invested. I don't see a huge downside risk, which is not to say that there could not be slightly more of a downside, but the risk reward is now in your favor, in the sense that if you're not invested, you might miss out on a up move. Just as from the COVID lows, within 5 weeks, the market was up 30%. Yeah. So.
But Devina, the problem for us, and I guess that was one of the key reasons why we fell the way we did from October all the way till Feb end, was A, valuations, and B, earnings weren't matching up to the valuations that you were, giving to those stocks. Is the earnings concern now behind us or not? Or is that going to be very fragmented?
It's going to be very fragmented. That's why I'm saying that you have to look at the market in 2 bits. One is the large caps and one the small micro caps. That those are small micro caps in a mad bull run, a lot of stocks run. Some which deserve it, many which do not deserve it. And again, people have not spent enough time in the markets. They do not know that these kind of stocks, whether it is thematic, like last year you had defense or PSU and so on, that the stocks that do that well in a bull run, after the fall in the next bull run, those very stocks may not be the ones who which go up. So as I said, you remain invested, but need not be in the same stocks or even the same strategies. Like last year, many people took money out of large cap SIPs and put them into small cap SIPs. Those are the sort of things you should not do. And also, I always say, easy way to find out where there is froth is to look at where the new thematic funds are being launched, where the NFOs are coming.
Okay, so while we do dig deeper into where the thematic funds are coming, for now we're going to take a very quick break, but we will continue our discussion with Devina after this very short while. But also Tamil Nadu has ranked the highest amongst other Indian states in terms of real economic growth for FY25 at 9.69%, and that's the highest in the past 10 years. The state's GDP rose to more than 17.2 lakh crore rupees, and that was led by professional services, communications, manufacturing and construction. In fact, its nominal growth rate was also robust at more than 14% for the year. Back with closing trades, right here on 18 hours, still 4% lower. I don't think it would make any sense to even go into individual stocks at a time when you've got pretty much just everything in the red. Trent is down 15.5%. That, of course, is a knee-jerk reaction that it's seen to its quarterly updates, perhaps. But look at the way some of these metal stocks are cracking. Tata Steel, 8.5% lower. JSW Steel down 8.5%. Hindalco down over almost 7%. And look at some of these large caps like L&T. Let's just bring up the intraday graph. L&T is now down almost 7% on the futures. Tata Motors, of course, they're pretty sensitive to the tariffs. Tata Motors down 6.5% right now. Axis down nearly 5%. Kotak, which has been one of the best performing, private banking large cap stocks year to date, that also is headed in for almost a 5% decline. But yes, there is Unilever. There's an Asian Paints, which have fallen relatively a lot less. In fact, Unilever is now just about bobbing into the green, or a Nestle, etc. as well. So there are those dots of green: Britannia, HPCL, Godrej Consumer Product. Well, let's see how long-lasting this trade turns out to be.
Yes, absolutely. But let's talk more about markets. Try and understand, actually, given the fact that we are in uncharted territory, but can we actually chart a new course this time around, Devina, given the fact that, yes, it's the time that now everyone is wondering what to do with their portfolio. Should they go ahead and buy in these dips and also look at reshuffling their portfolio? Do you think it's the right move at this point in time, or you should actually wait for the dust to settle?
By the time the dust settles in terms of the news, usually the market has already made its move. That's the way it is. Right. I mean, that's when I hire analysts, that's one of the hardest thing to get them to understand that in the market you always make decisions with imperfect information and with ambiguity. And so, yeah, I mean, if you look at the pattern today, of course, some of the defensives are doing better, which is the FMCG and also HPCL because of the oil price coming down. Metals, it is not surprising that the metals have taken a hit because that's not, while India is no major metal exporter, but if there are curbs on or tariffs on metals, let's say from China, India becomes one of the possible dumping grounds. So that's what is playing out in metals. So interesting times ahead. As of now, pharma, IT, auto components, all of that doesn't look too bad to us. Because that again, I mean, there's pharma, of course, there can be tariffs. He's warned of tariffs. But ultimately, tariffs are what? They are putting India at a relative disadvantage to any US manufacturer. But how many things does India export which can immediately be manufactured in the US? Not a whole lot. And otherwise, you have to look at relative tariffs because, as all macroeconomics textbooks tell you, that trade is not about absolute costs and prices. It is about relative advantages and disadvantages. So if you have a 26% tariff and everybody you are competing with has between 35 to 50%, then you are better off. So I don't think there's going to be a whole lot of direct fallout. But then, of course, if the US economy really goes into a tailspin, that will have repercussions on a longer term basis. It will also have repercussions on dollar as a reserve currency or the currency of trade. I mean, a year or two ago, I thought there was really no danger of any significant de-dollarization. But now, I think the world will look at Swiss franc and euro and yen and a whole lot of other things as reserve currencies. But India, I don't think we are in any very dangerous territory. So, I mean, slowly you should start getting back in if you have been out, because this is a number I've given often, that in 40-45 years, if you miss out on the 10 best days of trade, you miss out on 2/3 of the returns. So if you had 100, if you had invested 100,
not timing the market and time in the market.
Yeah. So if you had invested 100 rupees, which would have become, let's say, 75,000 rupees. In 40 years, you miss out the 10 best days, it will be 25,000. You miss out the 30 best days, you are down to less than 7,000. That's how dangerous it is. So everybody understands the risk of being invested in the market, but there's also a risk to sitting it out. I mentioned the COVID lows. From the COVID lows in 5 weeks, from March 23rd to April 30th in 2020, both India and the US were up between 28 to 30%. So you don't know. And all these other interesting thing is all these sharp up move days come when there is fear, there's anxiety, there's people asking these questions. In a bull run, the market doesn't run that fast.
Yeah.
Right.
Yeah, there are no exaggerated moves like this. Yeah. So, Devina, if someone listening to you wants to put in money tomorrow, day after, whenever, and has to construct a portfolio, say 100%, how would you divide that portfolio? And within equity, what would your recommendation be?
So your asset allocation shouldn't change every day. So that should be a broad thing which you have decided, that depending on your goals, your risk appetite, your time, your age, whatever. So all those things. And diversification should also be, I mean, let's not forget, in spite of the global turmoil today, that you should not just have only in India, but you should have global diversification also. So whatever is your equity allocation, I think it is time to be invested. So if your equity allocation, let's say, was 60 and right now you're only 40% invested. So if not in one lump sum, you should start putting it back in, so that, as I said, you don't miss out on those 10 best days.
Okay, counting down to those 10 best days. But Devina, such a pleasure having you in the studios, and hope you can make it more often.
Thank you for having me.
Thank you so much.